Imagine waking up one morning and realizing that while markets are collapsing in public, the real battle is happening quietly behind the scenes. A single trader has just placed a $300 million bet against silver, not as a rumor, not as a theory, but as a confirmed massive position built inside the futures market. Hundreds of tons of silver tied up in paper contracts, positioned to profit if prices fall further. And here's the part almost no one is talking about. This bet was placed at the exact moment governments representing most of the world's economic power gathered to confront what they openly call a broken and manipulated critical minerals market. That timing is not coincidence. That is a warning. I want to walk you through what's really happening here because this story is not about one trader, one metal, or one price chart. This is about control, supply chains, currencies, and the growing divide between paper markets and physical reality. Silver is sitting right in the center of that divide. Let's start with the short position itself. A Chinese billionaire known for operating quietly and for previously making enormous profits in gold has now turned his attention to silver. The size of the position matters. We're not talking about a hedge or a small speculative trade. We're talking about roughly 450 tons of silver represented through around 30,000 futures contracts. At current levels, that's roughly a $300 million bet that silver prices will move lower. After a sharp pullback of around 16%, that position is already showing paper gains. On the surface, it looks like a brilliant trade, executed with perfect timing. But markets don't exist in a vacuum. And while that paper bet was being built, something else was unfolding that changes the entire context. At the same time, U.S. leadership convened a critical minerals meeting involving more than 50 countries, together representing roughly 2/3 of global GDP. This wasn't a ceremonial gathering. The message coming out of those discussions was blunt. The global system for sourcing and pricing critical materials is failing. Despite all the talk about digital economies and advanced technology, physical commodities remain the foundation of everything. Without them, supply chains break, industries stall, and national security weakens. What stood out most was the open acknowledgement that current pricing mechanisms do not support sustainable domestic production. When prices are artificially suppressed or wildly unstable, mining projects don't get financed. Investors walk away. Supply becomes increasingly concentrated and dependence grows. That concentration is now viewed as a strategic vulnerability. The stated goal is to create predictable pricing and independent supply chains. In plain language, that means intervention. It means the era of ignoring distorted commodity markets is ending. Silver, whether officially named or not, sits squarely within that framework. It's industrial, it's monetary, and it's essential. And crucially, it's a market where paper trading has long overwhelmed physical availability. Now here's where things get even more interesting. While futures prices have been pushed lower, physical silver is doing the opposite of what you would expect in a healthy market. Dealers in key regions have been forced to halt retail silver sales entirely. Not because demand spiked overnight, but because inventory simply isn't there. When a dealer stops selling, that's not sentiment, that's shortage. Exchanges have responded by sharply increasing margin requirements, especially on silver. Margins don't get raised because markets are calm. They get raised when volatility and positioning risk threaten the system. Silver margins were hit harder than gold, which tells you exactly where the stress is concentrated. This is not about protecting individual traders. It's about protecting the plumbing of the market itself. Delivery data adds another layer to the picture. Large volumes of silver are being demanded for delivery in a month that isn't even considered a primary delivery period. Millions of ounces are moving out of exchange vaults while paper prices are falling. That divergence matters. It tells you that the futures price is no longer accurately reflecting real-world supply and demand. Then there's backwardation. Spot silver is trading at a premium to futures contracts, meaning buyers are willing to pay more today than they would for delivery months from now. That only happens when physical supply is tight and immediate delivery is valued more than future promises. Backwardation is not normal for precious metals. It's a stress signal, and a powerful one. All of this is happening against a backdrop of broad financial instability. Crypto markets have lost trillions in value in just a few months. Stock markets are selling off as weak labor data shows rising jobless claims, increasing layoffs, and a sharp slowdown in hiring plans. When layoffs rise while hiring freezes, that combination has historically preceded economic weakness. The US dollar, once the strongest major currency, has weakened rapidly. Other major currencies have gained significantly against it over a short period of time. That reflects growing concern over political uncertainty, aggressive and unpredictable trade policy, rising fiscal deficits, and questions around monetary policy independence. Capital is responding by reducing exposure and moving elsewhere. Where does that capital go in moments like this? Increasingly, it goes into tangible assets. That shift is visible in national balance sheets. Gold reserves in China have reached record highs, while holdings of U.S. government debt have fallen to their lowest level in nearly 2 decades. This is not speculation or opinion. It's a documented trend, a gradual but persistent move away from dollar-denominated assets and toward physical stores of value. When you put all of this together, the massive silver short takes on a very different meaning. In the short term, there is a real case for continued volatility. Sentiment had become crowded. Leverage was extreme. When too many participants pile into the same trade, corrections can be violent. Margin hikes force liquidations. Risk managers pull exposure. Prices overshoot to the downside. We've seen this cycle repeat multiple times since 2022. But short-term price action does not erase long-term structure, and the structure here is tight. Physical supply is constrained. Demand from industrial users and investors remains persistent. Governments are now openly discussing policy changes to address what they describe as market dysfunction. That is not a neutral backdrop for a massive paper short. This is the classic conflict that defines precious metals markets: paper pricing versus physical reality. Derivatives can push prices down temporarily. They can amplify fear. They can force leveraged players out. But they cannot create metal. They cannot refill empty vaults. And they cannot permanently suppress a market that governments themselves now view as strategically important. The timing of the recent paper sell-off, just ahead of a coordinated international meeting on critical minerals, raises serious questions. It looks less like random market behavior and more like a final release of pressure in a system already under strain. When stocks, cryptocurrencies, and commodities all move violently at the same time, that's not a free market functioning smoothly. That's stress propagating through the system. So what matters now is time frame. In the near term, deleveraging can continue. Prices can probe lower levels as positions unwind and fear dominates. Oversold markets can stay oversold longer than many expect. That risk is real, and ignoring it is dangerous. But structurally, the forces building underneath the silver market are pointing in the opposite direction. Physical shortages are intensifying. Policy direction is shifting. Supply chains are being reconsidered at the highest levels. And the willingness to tolerate distorted pricing is fading fast. That sets up a fundamental question that will define the next phase of this market. Does the paper short succeed long enough to force a deeper reset? Or does the combination of physical tightness and policy intervention ultimately overwhelm it, triggering a violent reversal? The answer depends on timing, not on whether the imbalance exists. For anyone watching this unfold, especially those focused on hard assets and currency stability, the lesson is clear. Don't confuse volatility with failure. Don't confuse paper prices with physical truth. And don't follow anyone blindly, no matter how confident they sound. This market is sending mixed signals by design. Fear is rising, volatility is everywhere. But underneath the noise, the same message keeps repeating. Physical silver is scarce, and the system built to price it is under pressure. Know which time frame you're operating in, manage your risk accordingly, and think independently, because the outcome of this battle will matter far beyond the silver market itself.